There's a trader who makes 200 trades a month, glued to the screen 14 hours a day, scalping every wick, chasing every breakout, trading every session from London open to New York close. He's exhausted, he's stressed, and at the end of the month, he's up maybe 3%, if he's lucky. Then there's another trader. She makes 12 trades a month, sometimes fewer. She waits, she watches, and when her setup appears, she strikes with precision and conviction. At the end of the month, she's up 8%. Consistent, calm, in control. This isn't a hypothetical. This pattern shows up in the data over and over again. The traders who trade the most almost never make the most. And today we're going to break down exactly why that's true, what the greatest traders in history understood about patience, and how trading less might be the single most profitable decision you ever make. Warren Buffett once said something that shook the entire trading world. He said, "The stock market is a device for transferring money from the impatient to the patient." From the impatient to the patient. Buffett didn't become the greatest investor in history by trading more. He became the greatest by trading less. He's famous for sitting on billions in cash, waiting months or even years for the right opportunity. When asked about his secret, he said, "Imagine you have a punch card with only 20 slots. Every investment you make punches a hole. When all 20 are gone, you're done for life." If you traded like that, you'd think incredibly hard before every decision. That mental model is the opposite of how most traders behave. Most traders act like they have unlimited punch cards. They trade as if every candle is an opportunity, but most price action is noise. And every time you trade the noise, you're punching holes in your account for nothing. Let's look at the math, because the math is devastating for overtraders. Say you have a strategy with a 55% win rate and a 2-to-1 reward to risk ratio. Solid edge. If you take 20 carefully selected trades per month, expected return is roughly 10 to 12%. Commissions eat maybe 1%. Net 9 to 11%. Now take that same strategy and trade it 200 times a month. Your theoretical edge is the same, right? Wrong. Commissions jump to 5 or 6% of your account. Slippage doubles because you're entering on market orders during fast moves. Win rate drops to 48% because you're taking B and C grade setups alongside your A plus setups. Net expected return after costs, negative 2%. Same edge, same strategy. One approach makes money, the other loses it. The only variable that changed was frequency. Jesse Livermore understood this over 100 years ago. In Reminiscences of a Stock Operator, he wrote one of the most important sentences in trading history. He said, "It was never my thinking that made the big money for me. It was always my sitting tight." Think about that. The man who made and lost fortunes on Wall Street said the money came from doing nothing, from waiting. Livermore would watch the tape for weeks, sometimes months, before making a move. He called it waiting for the right moment. Not a good moment. The right moment. Most traders can't sit still for 5 minutes without entering a position. Livermore would sit for 5 weeks. And when he finally moved, he moved with size and conviction because he had waited for the setup that stacked every variable in his favor. Patience wasn't just part of his strategy. Patience was his strategy. There's a psychological reason why we overtrade, and it's deeply wired into the brain. It's called action bias. Humans are hardwired to believe that doing something is always better than doing nothing. In a famous study, researchers looked at soccer goalkeepers during penalty kicks. The data showed that goalkeepers who stayed in the center of the goal saved more penalties than those who dived left or right. But almost every goalkeeper dives anyway. Why? Because standing still feels wrong. It feels passive. It feels like giving up. Trading is the same. Sitting in cash while the market moves feels unbearable. Your brain screams at you to do something. Enter a trade, any trade, but the data is clear. The best thing you can do in most market conditions is nothing. Inaction is a position. Cash is a position. And sometimes it's the most profitable position you can take. Mark Douglas talked about this in Trading in the Zone. He said most traders believe that more analysis and more trades equals more profit, but the reality is the exact opposite. He wrote, "The best traders have learned to think in probabilities." And thinking in probabilities means accepting that most of the time there is nothing to do. Douglas spent decades observing traders, and he noticed a pattern. The traders who blew up weren't the ones with bad strategies. They were the ones who couldn't stop trading. They confused activity with productivity. They thought screen time equaled profit. But screen time without discipline is just entertainment. It's watching a show and occasionally losing money. The traders who lasted, the ones who compounded year after year, were the ones who could stare at a chart all day and close their laptop without taking a single trade. That takes more strength than any entry signal ever will. If you're finding value in this breakdown, take a second and hit that subscribe button. We go deep on trading psychology every week at Executed Edge Trading. No fluff, no hype, just the mental frameworks that separate profitable traders from everyone else. Now let me share something that will reframe how you think about your journal. I went back and analyzed 3 years of my own trading data. Every trade categorized by quality. A-plus setups were trades where everything aligned: structure, momentum, volume, and timing. B setups had most things right, but one variable was off. C setups were trades I took out of boredom or impatience. The results were staggering. A-plus setups had a 71% win rate with an average reward of 3.2 R. B setups, 52% win rate, 1.4 R. C setups, 38% win rate, 0.7 R. If I had only taken A-plus setups, my account would have grown 3 times faster. 3 times. By trading less. Paul Tudor Jones runs one of the most successful macro funds in history, and he has a principle every overtrader needs to hear. He says, "I'm always thinking about losing money as opposed to making money. Don't focus on making money. Focus on protecting what you have. Every unnecessary trade is a risk event. The cumulative exposure of too many positions creates fragility in your account." Jones compares it to insurance. A good insurance company doesn't write every policy that walks through the door. They select carefully. They assess risk. They say no far more often than they say yes. That selectivity keeps them solvent for decades. Your trading account is no different. Every trade you skip is a risk you avoided. Every mediocre setup you pass on is capital preserved for the A-plus opportunity that's coming. Selectivity isn't about missing out. It's about surviving long enough to capitalize on what matters. Let's zoom out and look at the compounding math. Trader A takes 200 trades a year, wins 52%. Average winner is 1.5 R. Average loser is 1 R. After commissions and slippage of 0.1 R per trade, net expectancy is 0.08 R. Multiply by 200 trades, 16 R per year. Respectable. Now Trader B takes 50 trades a year, only A-plus setups, wins 65%. Average winner is 2.8 R because she holds longer with more conviction. Average loser is 1 R. Commissions are negligible because she trades so rarely. Net expectancy per trade, 1.32 R. Multiply by 50 trades, 66 R per year. 4 times the return, half the stress. A quarter of the screen time, dramatically less drawdown exposure. This is the power of selective trading. Fewer trades, higher conviction, bigger returns. Ed Seykota, one of the original system traders and one of the most profitable in history, had a beautifully simple philosophy. He said, "The elements of good trading are 1. Cut losses. 2. Cut losses. 3. Cut losses. If you follow these three rules, you may have a chance. But here's what most people miss about Seykota. He didn't just cut losses on bad trades, he cut losses on bad habits. And overtrading was the first habit he eliminated. Seykota ran his systems and walked away. He'd go hiking, play music, spend time with family. He trusted his process and never felt the need to constantly interfere with it. He said, "The trading rules I live by are 1. Cut losses. 2. Ride winners. 3. Keep bets small. 4. Follow the rules without question. 5. Know when to break the rules. Notice what's not on that list. Trade more, trade faster, be in the market at all times. None of that. So how do you actually make the shift from overtrading to selective trading? Here's a practical framework. Step 1. Define your A-plus setup in writing, not in your head, on paper. What does the perfect trade look like? What structure, what momentum, what volume, what time of day? Be ruthlessly specific. If you can't describe it in 3 sentences, you don't know it well enough. Step 2. Implement a daily trade limit. Start with 3 trades maximum per day. If you've been taking 15 or 20 trades a day, 3 will feel agonizing. Good. That discomfort is your brain rewiring. Step 3. Track your cost of trading. Calculate the total commissions, slippage, and spread costs you pay each month. Most overtraders have never done this. When they see the number, they're shocked. I've seen traders paying $2,000 to $4,000 a month in friction costs alone. That's money that disappears before the market even moves. Step 4. Create a waiting ritual. This is something the best snipers in the world understand. A sniper doesn't fire at everything that moves. They wait, they breathe, they observe. And when the perfect shot presents itself, they take it with zero hesitation. Your waiting ritual is what you do instead of trading. It could be reviewing your journal, annotating charts without entering positions, studying your past A-plus setups, walking away from the screen entirely. The key is replacing the action of trading with the action of preparing. You're still engaged with the market. You're still working, but you're not bleeding capital on mediocre setups. Step 5. Review weekly, not daily. Daily P&L tracking makes you reactive. It makes every red day feel like a crisis. Weekly reviews let you see the bigger picture. Did I follow my rules? Did I only take A-plus setups? That matters more than whether Monday was green or red. I want to leave you with something that ties this together. There's a concept in Japanese martial arts called Mushin. It means mind without mind, a state where you act without overthinking, without forcing, without grasping. The swordmaster doesn't swing at every opening. He waits in stillness until the moment reveals itself, then moves with total clarity and commitment. Trading at its highest level looks exactly like this. Not frantic, not busy, not glued to every tick. Calm, patient, selective, and when the right moment comes, decisive. The traders who last decades in this game share one quality. They learned to be comfortable doing nothing. They learned that their edge doesn't come from more trades. It comes from better trades. Fewer, higher quality decisions made from clarity rather than compulsion. That is the real executed edge. Not trading more, trading better. And trading better almost always means trading less.